Hello, everybody. Welcome to Wall Street Hackers, one of the most exciting and well-watched shows on the Pod TV network. I'm Nick Pellavito. I'll be your moderator, and we're going to explore the area of stocks, the market, what you should be doing with your funds, especially if you're a good investor. And with that, we are going to bring in the hacker himself, a graduate of UCLA with a degree in economics, a law degree from the University of Miami, and a master's in business administration from NYU. He also spent 17 years on the streets of New York and working in the investment area. And with that, with no longer ado, we're going to bring in the hacker himself to talk about the markets, quote of the week, stories of the week, and of course, Peter's picks. With that, bring in none other than Peter Bennett. Peter, welcome to your show.
Right. We like to always clarify. I wasn't actually on the street. I was on.
Yeah, at least you weren't on the street. You weren't homeless.
You know, you made that joke the other day. I thought it was kind of cute.
Right.
So welcome to Wall Street Hackers. This is the 314 edition. You can catch a new edition every Thursday or Saturday, depending on your distribution channel. And so we always start with the markets. More bad news for the Fed. What's surprising? I mean, we've been saying it for a year and a half, 2.5 years. You know, the Fed is basically behind the curve and inflation is not under control. And so the CPI came out for February at up 0.44%. This is a 5.4% annualized rate. This is much, much worse than the 2% goals that they have. The core CPI came in for February, and the 3-month average was 4.2% annualized. This was the worst since May 23. The core service CPI was up 5.6%, way off 2%, and that was after a 8.2% spike in January. Again, the 6-month average was the worst since May 23. So this is exactly what we predicted last fall. We said energy prices are going down, so inflation looks better than it should be. But it's not going to last. Energy is either going to level or go up, which it has been doing. And it's kind of predictable because it's cyclical. So now this is hurting the inflation numbers. This is not a good situation. And inflation is so far out of control. In terms of the market predicting rate decreases from the Fed, finally, it's starting to wake up. We've been saying it for a year, whatever. There aren't going to be 6, 5. Now the market is finally, the futures market is pricing in 3 rate decreases for the year. But I doubt there will even be 3. I mean, it's questionable. Some people are saying maybe there won't be any or 1. And the market is pricing in eventual rate decreases that will be easing the pressure on companies. But in the long run, it's probably not going to happen. And unless you're looking at a really long run, because inflation is so far out of control. Very often, inflation takes 10 years to control or more, and the Fed has not been pushing it. This is the thing. And this would a lot of people might disagree, but a few people are starting to say it. Maybe the Fed needs to raise the rates. And I personally, if I was on the Fed, would probably raise the rate or at least start talking about raising rates. I don't think I'd actually do it at this point. I'd be cautious, but I start talking about it to sort of put a damper on the market's hopes that rates are going lower. But the market hasn't been up that much anyway. You know, as I pointed out, everybody keeps saying new highs, but if you look at the real rate of return, it's been about 3%, a little over that since 2021 high. So it goes up just an inch more than where it was, and everybody's like, oh, new high, but it doesn't mean that much when you look at inflation. under the Biden administration, because I didn't look at the inflation rate since 21, but I know the average has been 6% a year since under the Biden administration. So if you're making 3 and you're losing 6, that's not making money in real terms. And this is sort of a prediction of where I think it's going to go for a while. I think the market might gradually go up, and there will be opportunities. And, we are fully invested in our model portfolio, and we believe the market, you can do well if you're in the right stocks and investments. But I think what's going to happen is the market might go up a little bit for the next year or two, but lose ground against inflation. So, and even maybe lose ground against 5% treasuries. So are you really making money? I don't think so. That's not real money if you're losing money against the real dollar. So what to do, as always, always we stress own oil production and oil pipelines. Pipelines, because you can get so much yield growth and I think a tremendous amount of safety. Oil production, because that's where inflation is going to show up. I trust oil to go up with inflation more than gold. Gold doesn't correlate as well as you would think with inflation, but oil, for a lot of reasons, almost has to go up if inflation is going up, and it also drives inflation up. So that's an important point. Also, whatever allocation you have in stocks always should be in dividend producers, because our favorite chart, which covered 50 years to 2022, showed that dividend stocks doubled the performance over that 50 years to 2022 of the S&P 500, and dividend growers and initiators tripled the performance. So this is why a few weeks ago I had recommended SCHD, which has done very well, and I have an even bigger allocation to that. And finally, be very cautious. You really have to be careful what you're doing now, because it's so easy. It's a very difficult macro environment. A lot of companies, stretched out their financing when rates went up, but sooner or later they have to refinance, and it's going to be pressure on them if they can't raise their rates that much, their costs. I'm sorry, if they can't raise their prices that much, their costs are going up because of inflation, and their interest cost is going up because of bond rates and refinancing. So it's sort of a gradual process, and this is the higher for longer, but not that high scenario, which I always say not that high, I add to the Fed. I think they're just delaying the pain. So we will see, but you have to be very careful. And the other point about the markets is the quote Magnificent Seven. Many people are saying now it should be the Magnificent 3 or 4. So Apple, if you look at year to date, is down over 10% this year. Tesla, which we're going to be discussing in the investment of the week, is down now over 30% year to date. Google's about flat. So a lot of those Magnificent Seven aren't there anymore to drive the market up. Now, NVIDIA has done tremendously well. I was in there for years ago, but I missed a lot of the recent one. I'll admit that. It can't be perfect. But if you look at NVIDIA right now, which I think was down today, but its PE is 77 times, and its price to cash flow is 45 times. Will it keep going up? Who knows? Because it's being driven by future. But just like Amazon, some analysts say, well, they built 10 years of future growth in there. What if the future growth isn't in there? I don't know where NVIDIA is going, but I'm not in there because it's speculative to me. And generally, I like sure things. So, quote of the week. This is from Barron's Daily, March 12th. It's, again, JP Morgan Chase CEO, Jamie Dimon, who is a very sharp guy. And it says, he has some advice for the Federal Reserve. It needs to wait longer before cutting interest rates. Quote from the article. Dimon said he wouldn't start lowering rates until after June, on a day when there are fresh consumer price figures. By the way, the PPI today also was much more than expected. Growth is still strong and inflation is well above target. These figures, if the Fed is data dependent, would suggest a longer pause before cutting is prudent. After all, the central bank's credibility is on the line after inflation spiked in 2022. So this is what I'm saying. The Fed should be more aggressive, and they're just playing this longer, just delaying the pain, I believe. And it's Okay, now the final point again is you can still make some nominal profits in the market, but and still lose against inflation. So you have to be careful. 5 most interesting stories of the week. So this is the first one, and we covered this last week, but it's such a significant story, and it also relates to our investment of the week. The story came out according to a study by data firm Analytics that EVs release more toxic particles into the atmosphere and are worse for the environment than their counterparts. The company found that brakes and tires on EVs release 1,850 times more particle pollution compared to modern tailpipes, which are efficient, quote, efficient exhaust filters, bringing gas-powered vehicles emissions to new lows, because the gas-powered vehicles are becoming more efficient, but the EVs are 30% heavier. So this causes a lot of friction on tires and on brakes. And those are made of petroleum products. So it's not pretty, and it really questions the whole world's picture and goals of creating EVs around the world as the main transportation source. It is questionable, but add this to this study that I highlighted maybe a year ago. I don't know, Manhattan Institute, really interesting stuff. But this really is a great quote from them, from their report. This was August 21 report. Quote, investors and politicians embracing a vision for an all-electric car future believe that path will significantly reduce global carbon dioxide emission. That's far from clear. A growing body of research points to the likelihood, they said likelihood, that widespread replacement of conventional cars with EVs would likely have a relatively small impact on global emissions, and it's even possible that the outcome could increase emissions. They're saying back in 21 that EVs might increase emissions. They highlight that a single battery providing a useful driving range weighs about 1,000 pounds, which is a fact, and it requires the mining, moving, and processing of more than 500,000 pounds of materials. So basically, you're stripping the planet and doing mining, which is very energy polluting. And so I wonder if these two studies combined, what would be the effect? In other words, you combine the tire study with the mining study, and maybe EVs are much worse for the environment, even on carbon. So there's a lot more work that needs to be done, but we're heading, gangbusters into the EV future, supposedly. But of course, consumers are questioning that too, just as issues with coal batteries and things like that. So we will see, but that also story will relate to our short of the week, which I never do, but this week I'm going to talk to you about Tesla. So almost never do. Number 2, interesting article. President Biden, as a lot of people know, in the State of Union address, called for $5.5 trillion in tax increases while spending $7.3 trillion on programs. But a few points about that. At least one analyst said it's actually $7 trillion. He's using lower numbers. But also I heard, I didn't research this, that this proposal would bring the tax rate on U.S. corporations higher than the tax rate on Chinese corporations. Now, China's a communist or semi-communist country, the way they operate as a business. But basically, we're talking about higher rates than Chinese companies. That might make us a little uncompetitive, might hurt the environment. And this will relate to our discussion of the week, which is why the government seems unaware that tax increases can actually lower revenues and tax decreases can actually raise it. That will be after the break. Interesting story number 3. Dying before our eyes, overdose deaths push Oregon lawmakers to end drug decriminalization experiments. So according to at least one senator, Oregon is now ready to end its drug experiment. And this is becoming because of skyrocketing overdose deaths. And so a new bill has been passed. I think it'll happen eventually. Oregon had decriminalized all hard drugs, including fentanyl, heroin, cocaine, and methamphetamine. Well, that didn't seem like a good idea then. And after all these deaths are increasing, it probably seems like a worse idea. It's probably not good for the social environment there either. Interesting story number 4. Very interesting story about the Supreme Court. The Supreme Court is about to rule on ending the nation's homeless encampment chaos. So the Supreme Court is going to take up a case called Grants Pass versus Johnson. Grants Pass is an Oregon city who passed laws restricting street homelessness, but the San Francisco Ninth Circuit Court of Appeals denied that. But many are expecting the Supreme Court to reverse Grants Pass. Now, in doing so, the court will authorize cities to clear dangerous encampments that are prevalent in urban America. So what's interesting is if the Supreme Court says, no, you can pass laws controlling the homeless encampments, then it's going to put pressure on local officials, because many local officials around the country insist, we hear your complaints about these street conditions, but we can't do anything because the courts have said you can't do it. So this will be a really significant case when it comes up. Finally, we try to add some semi-humorous stories in for interesting story 5. Pentagon admits its expensive UFO mistake. So after spending tens of millions of dollars funding dodgy efforts to determine if little green men have visited Earth, the Pentagon investigated all the available reports since 1945 and concluded, this is not surprising, that neither aliens nor their technology have ever visited Earth. So this cost tens of millions of dollars to conclude, but maybe it was worth it. I don't think so. We'll take a quick break, and then we'll talk about the investment of the week and the panel discussion. See you soon. If we have a commercial. If not, I'll keep going.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Culiet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
Okay, and we're back. So the investment of the week. Disclaimers doubly important this week because this is much more speculative than I usually get involved in. This show is for entertainment only, no guarantees, only our opinions, and consult your financial advisor. So there's a few points. I'm going to be talking about shorting Tesla. And first of all, 3 points about that. Number one, I started shorting it yesterday at 178. So, and it's down significantly since then. So I got in at a better rate for a short, but I'm staying with it. Number two, I only put 1.25% of my total allocation in there because shorting is very dangerous. You get whipsawed. I'll be talking about that. And three, if you want a safe investment, just go with MPLX because you can look at this. I've been recommending this for 2.5 years. You can look at it when it was at 13. I was recommending it at 18. It still looks fabulous. You know, over an 8% return that's tax favored. It's way undervalued, huge cash flows. I'll probably talk about that next week. But for this week, it's Tesla. So there's, again, very speculative to short. But I'm going to talk about, first I'll talk about the dangers of shorting, I guess, to say you better be careful. So you can get whipsawed because you have a lot of people selling short and then they might take profits. So if you short too much, it can jump up and then you get scared and you get out. So if you're going to build a short position, you really have to be careful, and you have to be careful about the whole thing because, the markets are unpredictable. If it was easy, everybody would just short it and that'd be over. But it's going to have cyclicality. That said, there's a lot of reasons why I'm shorting Tesla right now. Number one, that story about EVs. I mean, geez, I don't even know if EVs are going to be around in 10 or 20 years when they start really studying this stuff. EVs may be the DeLoreans of the 60s or whatever it is, because there's a good chance they're not helping the environment at all, and a decent chance they're hurting it. So maybe EVs will go out of fashion and people won't have EVs eventually. But there's a lot of financial reasons why too. Number one, they have a lot of competition from China. There's a company called BYD, and they overtook Tesla as the largest EV company in 2023. Number two, many other auto companies are catching up to Tesla. And I kind of predicted that, but I wouldn't have shorted it earlier because, just following it. But now there's a consortium of an alliance of three companies, Renault, Nissan, and Mitsubishi, that are on track to rank second in 25. So now Tesla's not second anymore. There's also predictions that they'll be the fourth largest EV company by 2025, with Toyota coming up on their heels very quickly. So they've lost some of their first mover lead. Also, the company keeps discussing artificial intelligence, and they're charging $12,000 per vehicle to include it. However, the company still does not have full self-driving running, and Waymo is making a lot more progress. They're in active tests, and Tesla hasn't even reached that yet. So that's not a good sign for them. Also, the company's growth rate and margins have declined substantially year over year. And the company itself has said that it expects margins to tighten, not to mention the economy's heading for tough times. So, that's not good for the auto market either. So again, you have to be really careful doing this. Be careful, because if you're short and you get scared, you get up. But that's true of any position. You can take a long position, and if it goes down, you get scared. So you always have to look at your positions and say, this is something I can ride out, or risk I'm willing to take. Consult your financial advisor. So also, I'll give you the positive on Tesla first, but I'll say this too. So several people, JP Morgan seems positive on them. A lot of people have much higher ratings. The scope on the analyst predictions is all over the place. It's like 80 to 325. I'm more in the lower camp. But yesterday, after I shorted Tesla, Wells Fargo came out and said their target's 125. That would be a big drop. And that must have scared the market, which is another reason I'm reasonably confident shorting it right now. Because if I read that, I'd be like, I don't need that kind of risk, And so there may be a lot of people getting out, and there might, but who knows? I'm watching this, by the hour, whatever, and you have to be very careful with shorts. So if not, go with MPLX. It's safe. I'll cover that next week. So panel discussion of the week, panel question. How do many in government not know that tax increases can not only slow an economy, but also result in decreased government revenues? Again, it's not just the fact that they can do it, but how do many in government not consider that? Background. So this is pretty mathematical. You can look at federal tax receipts since the income tax passed in 1913, and there's a pretty clear pattern. When tax rates went up, a lot of times, it's pretty consistent, the revenues went down actually, and the thought would be, I guess, the federal government sucking out money from the private sector, so it doesn't produce as much. So in particular, President Kennedy lowered taxes, and the economy took off tremendously, and there was a big increase in tax revenues. Ronald Reagan, same thing. He lowered taxes substantially, and the economy took off from a low point, and the government revenues soared. Now, some people criticize that and say, oh, but the deficit went up. Yeah, the deficit went up because Reagan spent a lot of money on the military, and because he was trying to defeat Russia, the Soviet Union then, and he did make them fold, and that was part of his strategy. But that doesn't mean that the tax decreases didn't help. It increased the revenue. President Trump, same thing. The economy came up. It did better under President Trump than before. And again, revenues went up. So President Biden just proposed $5.5 trillion in tax hikes, or arguably $7 trillion in tax hikes, plus another 7.3 in new spending, which won't help the inflationary environment for sure. The tax cuts from Trump, by the way, were the largest in history. And this is a key point. They're set to expire in 2025. So if there is no new tax law at all, this will be the largest tax increase in 2025. So, and the only way probably that they won't expire is if we get a Republican House, Senate, and presidency. But it's possible they'll be renewed. But there's a decent chance they won't be, and that's a real danger to the economy. So, the real question is why and how. How is it, Nick, that the government doesn't even consider this as a possibility, that tax increases won't actually increase government revenue?
I'm not sure they have any clue what's going on when it comes to economy, Peter. I think that's the real problem.
I like that.
And
that's probably the best.
well, they don't. It's not. It's a bunch of lawyers, but not a bunch of educated economists that are on there. But with that, I did look at the 2025 budget. We're going to be discussing that on Monday, I believe, at Economics with David Walker, the former Comptroller General of the United States. Most people have not even seen the budget, but the budget is 188 pages. It's for 2025. The 2024 budget's already done. You can see that online, because when you go to school, the professors or nobody ever shows you what the budget looks like. When you look at it in detail, it's about $7 trillion in spending, a $1.7 trillion deficit this year, and the numbers get worse. The deficit will grow to, according to them, OMB, $50 trillion. It's going to grow to, and 116% of the GDP. And it even gets worse. Our biggest budget item is interest on the national debt today. So if you look at from a spending standpoint, which Congress does not address, neither does the president, we have a big spending problem. Now let's go look at the revenue, $5.5 trillion.
Wait, let me just throw in a footnote, Nick, and then you can go on. So that's only the funded debt, which I always highlight, and we highlight that in other shows too. The thing is, the government owes. Everybody's concerned about the 37 trillion and not worrying about the 125 trillion.
Yeah, we're not even
Medicare debts. And that's going to explode in another 4 or 5 years, also.
That is correct. You're not even looking at the unfunded liabilities on Social Security and Medicare. This is just the U.S. government debt, and it's bad news and getting worse.
It is.
116% of debt to GDP is unheard of in this country, even after World War II, which means that if we took every dollar we made this year and we gave it all to pay the debt down, we still wouldn't have accomplished it. It shows how bad the situation is. Now it comes to the tax increase. I don't mind the targeted tax increase, but you're never going to solve the problem if you have the spending increase.
That's
what you're doing is you're wasting your time increasing taxes if you're not going to address the spending issue.
Let me just put up, because we're running out of time again. We're always short on time because we get so much in half an hour. But yeah, I agree with you. Targeted. There are certain places where they could raise taxes, but it has to be really intelligent and not let's go after the quote rich. I mean, the rich can pay more, but you have to be really intelligent about designing this and not hit the middle class that much. But even the rich, you have to be careful where you hit. So you have to be really careful about it. But your key point is, you're right. It's not going to solve any of this problem. There's a dollar extra allowance for somebody who's spending $1,000 a week.
Yeah, it doesn't matter if you're running a family household and you say, "Hey, I made an extra $100,000 this year. I feel really, really good." But guess what? I spent $200,000 more than I did last year. You're going nowhere. So what's happening right now? It's a going nowhere situation, and it's going to get worse. And
I have to conclude. Unfortunately, it's so hard to get in half an hour. So, but we're short on time again. So. the bottom line is watch inflation carefully. Watch what happens with this tax increase, and we'll see you next week.
Yeah, we got to go, but yeah, we'll be
Gotta go.
back next week.
We're
We'll
past
see you.
30.
Bye-bye.
Yeah.